So, we already went through a quick overview about the global minimum tax initiatives within our previous videos. And we already highlighted that global minimum tax initiatives are part of BEPS project, which was established to amend the long-standing international tax principles. Also, as explained previously, that BEPS project has mainly two phases in BEPS Phase 1, which then triggered BEPS second phase, which focuses on the tax challenges arising from the digital economy, and here both G20 and OECD came together with an agreement including two pillar solutions to address and tackle the tax challenges arising from the digital economy. Also previously we dived a bit deeper into Pillar 1, which provides the profit allocation model, as the profits would be reallocated to market jurisdictions regardless any physical presence there, trying to ensure that multinational enterprises are paying a fair share of tax wherever they operate. Well, it is recommended to watch those videos first to have a better understanding for today's video, as we are going to also dive a bit deeper into Pillar 2, which provides the global minimum taxation model. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. Well, so under Pillar 2, multinational groups with global consolidated revenue over €750 million are subject to a proposed minimum effective tax rate of 15% on income arising in low-tax jurisdictions. So, in line with the country-by-country reporting current requirements, all impacted multinational groups would be required to pay a minimum effective tax rate of 15% in every country where they operate. For any other businesses that are below the mentioned threshold, then they wouldn't see any impact, as they would remain under the existing corporate income tax regime within their jurisdiction. Well, so here Pillar 2 aims to ensure that the income of multinational groups is taxed at an appropriate tax rate and such tax is collected and paid accordingly. Also, it is important to highlight that Pillar 2 is also more than just a global minimum tax system. A treaty mechanism is designed to protect developing jurisdictions, and that's what we call the subject to tax rule, which is going to be explained later in this video. So, the ultimate goal here is to avoid the race to the bottom on tax rates between competing countries to obtain future investments. Good. So now let's start talking about the rules of Pillar 2, and here we would say that it would mainly include two proposals that operate almost independently of each other. Here we are talking about global rules and subject to tax rule. So let's start with the first rule, which is global rules. And here we would highlight that global rules would be qualified as the main element of Pillar 2. Also here global rules works by imposing what we call a top-up tax, which is the difference between the calculated effective tax rate of the multinational group and the 15% minimum tax rate in case it was less than 15%. Well, global rules initially would include the following measures. The income inclusion rule, which is a method of accounting for the top-up tax under Pillar 2. So, income inclusion rule imposes a top-up tax on the ultimate parent that has foreign subsidiary being undertaxed. So, it determines when the foreign income should be included in the parent company's taxable income. Here the process would be very straightforward. Once a jurisdiction has been identified as undertaxed jurisdiction, then the difference between its effective tax rate and the minimum rate under Pillar 2 is expressed as a percentage to be applied to the parent company's share of the undertaxed income. So in general, the ultimate parent entity is required to apply the income inclusion rule once it owns an ownership interest in a low-taxed entity at any time during a fiscal year. In this case, the ultimate parent entity accounts for the top-up tax in its jurisdiction in case that jurisdiction applies the income inclusion rule. If it doesn't, then the right to account for the tax flows down the group to the next parent company where there is income inclusion rule. Good. Now let's move to the next tool under global rules, which is the undertaxed payments rule. which acts as backstop as it supports the income inclusion rule to deal with circumstances where the income inclusion rule is unable by itself to bring low-tax jurisdictions in line with the 15% minimum rate. So, if the top-up tax is not fully allocated under the income inclusion rule or, for instance, if there was no income inclusion rule in the relevant jurisdiction. So here the undertaxed payments rule seeks to deny deductions or take further actions to collect tax that wouldn't be collected under the income inclusion rule. Well, so with this the concept of GloBE rules is clear, and now let's try to understand how it works. Let's try to simplify. At the beginning, GloBE rules operate by calculating first the effective tax rate of the multinational group within the jurisdictions that operates in, and then it is comparing the calculated effective tax rate with the 15% minimum tax rate. If the effective tax rate is less than the 15% minimum rate, then additional tax or top-up tax would be payable. However, if the effective tax rate is 15% or above, then no impact would be in place. Good, so as a next step and once the top-up tax is calculated, it would be collected as follows. It would be collected by the low-tax jurisdiction itself, under what we call qualified domestic minimum top-up tax. And here the qualified domestic minimum top-up tax is a mechanism that allows the jurisdiction to apply a top-up tax to the local excess profits of the multinational group when those profits are subject to effective tax rate being below the 15% minimum rate. Well, so as we can notice that GloBE rules here prioritize the local jurisdiction to have taxing rights over its own income. Good, now in absence of the qualified domestic minimum top-up tax mechanism, then the top-up tax amount would be collected either by the income inclusion rule or the undertaxed payments rule. Good, that was for GloBE rules, and let's move to the next element on Pillar 2, which is the subject to tax rule. So as we were highlighting at the beginning of this video that Pillar 2 is more than just a global minimum tax system, it is also a treaty mechanism that is designed to protect developing jurisdictions. So unlike the income inclusion rule or the undertaxed payment rule, here subject to tax rule is not concerned with effective tax rate as it focuses more to tax intercompany payments that would be undertaxed. Let's simplify. Under subject to tax rule, any jurisdiction that doesn't exercise its taxing rights adequately and sufficiently over the receipt of certain payments such as interest, royalties, and some other payments as well. As proposed, it would be a percentage up to at least 9% as a minimum rate. Then this jurisdiction would have the right to deny the relief within the Double Tax Avoidance Treaty to be up to the globally agreed 9% minimum rate. So, in essence, the subject to tax rule is effectively a treaty override provision enabling the jurisdiction to protect its taxing rights over the transfer of such payments. Good. That was a quick overview for Pillar 2 being part of global minimum tax initiatives, and further videos covering this interesting topic are coming, so like and subscribe if you would like to see more videos, and thanks for watching TaxGate.